Welcome back to the Dividend Diplomats YouTube channel, guys. You've got Bert, the Hurt, and Lanny, your boys here, your favorite dividend investing channel. Bert's making sure his hair is looking fresh, fresher than death. And today, guys, we want to talk conversationally about investing, making it simple, diversifying, reducing the stress, helping you sleep at night, and what the trade-offs are, what other alternatives there might be when it comes to investing, and how Bert and I were kind of refocusing, especially in 2024, especially after the last 12 to 48 months in the stock market, in investing. Kind of some great takeaways, and kind of where the diplomats may be investing more of in 2024.
I think you mean the last 12 to 48 hours in the market is what's really prompted this. But before we jump into this, subscribe to the channel, give this video a thumbs up. 2024 is going to be all about rebalancing, doing what you can, and pushing forward even more to financial freedom.
Yeah, guys, Bert and I, we've both been investing over a decade, going on 15 years almost on my end. And, if we recapped really everything that's happened, going back to the pandemic, we're dividend investors. We're looking to build passive income streams. We all want to get to financial freedom. We're all doing it on different personal levels, different investing levels, different risk appetites as well. We've always preached, Bert, right? Like never chase the high yield. We've never been about, oh, buy the yield because it's so high. We've never talked about that.
No, and that's why in our screener, to go off that, it's not just about yield. Yield's the bonus metric. We always are very clear that yield is the bonus. We always make sure we look at the other ones. We're not saying we're not perfect, that a yield doesn't sometimes draw us into a stock to look at it, but we're definitely evaluating a stock more than just the dividend yield from that. That's a very important point that we want to make sure to emphasize.
After the last 4 years, as dividend investors, I know between Bert and my portfolios, there's been a few dividend cuts. Recently we just had the Walgreens one. Yes, go check out Saturday's video. Walgreens, yep, boo. We've had Shell, one of the biggest oil companies, reduce their dividend after such a long time. We've had WestRock, Intel, Paramount, AT&T. We've had quite a bit in the last 48 months. And kind of makes you think about, okay, not exactly what we're doing, not exactly the stock screening metrics, because price to earnings is still extremely valuable. Dividend payout ratio, if anything, is very valuable. History of a track record of a strong dividend growth pattern is still valuable. But I think it's kind of come down to really like, okay, how much in individual stocks, Bert, should be a component of the overall portfolio?
Yeah, and that's an interesting question, especially as you've seen a transition with us too. Lanny's obviously been famously buying VYM for 3.5+ years now, adding more to the VIG, to the VOO to get that trifecta. You betcha. I've been adding SCHD to my wife's portfolio. I've started adding VIG myself while buying individual stocks. And ETFs have become a much larger component of our investing strategy and a lot of others, because the quality of these are getting a lot better too, and they're getting more sophisticated themselves.
Correct. And the beauty, again, you can buy as many individual stocks. If you held some of these stocks, that cut or reduced their dividend, hey, maybe you got a lot of appreciation out of it. Shell's popped.
Sure.
Intel obviously has popped dramatically. WestRock's getting acquired, so that stock has popped. But obviously, there's still the goal. If the goal is passive income and not seeing it drop, then you probably weren't too thrilled still from these dividend cuts. And as Bert said, the ETFs have just been able to keep it really simple. Again, he said, I've been doing VYM for 3.5 years, and they are achieving exactly what I wanted it to achieve. I know it's going to lag the S&P 500 performance, but I know it's going to have a higher dividend yield and a very consistent dividend growth rate between 6 and 8%. And they continue to deliver that.
Yeah. And that's part of that little 6 basis point expense ratio that you pay, right? Like that you don't have to monitor for VIM. It's what is it, 400
Yep.
stocks, you're not monitoring the performance of those 400. Vanguard's doing that. Same thing with Schwab with SEHG. They only have about 100 stocks. I think it's 104 maybe. But guess what? You're not monitoring those for individuals. You're not doing the annual rebalancing for SCHD. You have other people that have the time to monitor it, have the tools to do it on a much more sophisticated level. And that's why the ETFs make it so simple and are such an appetizing option for even dividend investors like ourselves that still like to review individual stocks.
Yep, we still do, and we're not buying individual stocks. We are, but if it comes to time where if you don't have enough time to really research and know a company and love, not love a company, but love the business model and know that it's going to be profitable for a long time. If you can't dedicate the time, maybe transitioning more into ETFs is the right thing. And obviously, I've been doing that. I still buy a ton of individual stocks, but I'm very much more. I'm stubborn to begin with, as Bert knows. But I'm
Yeah,
much more
don't
like, hey,
say.
if they don't hit these prices, then hey, I'm just not deploying capital just because.
Yeah.
Um, and I haven't been, more happy with seeing the portfolio grow by just the ETF investing and consistently doing it, not timing the market.
Yeah, and I think that's the key piece of it. You no longer have to necessarily reach for the individual stocks. You have other tools at your disposal. We're lucky with money market accounts having higher interest rate percentages that can give you a little bit
For
more to
now,
wait and be patient. Yeah, for now, but you can be patient where you don't necessarily feel like you need to make that investment. You have the time to do it. And I think that's the key piece. And like you were saying, Lanny, Vanguard, they make it simple. Their yields a little but above 3%, depending on, can get up higher, obviously, where the price is. You know there's that growth that's going to be there. That's just simple. It's that simple. You're not worrying about, for Westrock, for example, what's going on in the packaging industry. Walgreens, you're not worrying about how's their US pharmacy doing, what contracts are they going through, what are people behind the scenes actually thinking about Walgreens. They take that out of this equation.
no, exactly. And I mean, you have lower volatility typically with the ETF. Obviously, if you have the S&P 500, it's going to track right against the S&P 500. Um, but now, obviously, there's a give and take, right? ETFs are great, but you also then give up
Yeah.
the potential home run, as we like to call it. You might give up the chance to see Apple stock or Microsoft stock or Pepsi skyrocket, John Deere pop up like they have over the last, 5 years, as we've talked about. You might miss that, but you'll get a component of it, but you might miss that.
Yeah.
But in return, you get less stress, right?
Yeah, absolutely. You're not waiting for, sure, like let's use Intel as this example, right? Intel was in the 40s, they cut their dividend, they traded for months in the 20s, months in the 30s. No one would have expected Intel to hit the 40s and 50s and do the turnaround that it had so rapidly. Like that's an anomaly. But a lot of time you're sweating it out. Look at what's going on with AT&T, who hasn't rebounded. You're just wondering, when is that ever going to come back? If it's ever going to come back. Like, for every home run, you have the other stories too. And I think the ETFs take that out of it too.
Yeah, I would agree. I mean, again, you might have, lower income possibilities, right, Bert?
Yeah, but stress is gone. And I think that's a key component of it. So I guess
So,
that's
yeah,
the
go ahead, Bert.
$1 million question here, Lanny, is like thinking through this. We're obviously talking about ETFs now. We're still individual stocks. Has this changed has the dividend cuts we've experienced over the last 24 months, has that changed a potential allocation for like what you're targeting between ETFs or individual stocks?
I think it just maybe reassured and reaffirmed that, hey, buy it when the price is right. So that's a check mark. Keep doing the ETF strategy because obviously it has paid well. It's paid dividends, guys. No pun intended. But it also made me go, okay, what dogs do I have in the portfolio? And that's where I should allocate my time now, is more of allocation of value. Walgreens, Warner Media, even Intel with the pop that they've had. There's a handful of stocks where, can I use some of the losses to offset some of the gains and then move that all into a VYM or a VIG or a VOO?
Yeah.
Now it's time to clean up.
Yeah, and I very much agree with that. You can use this loss to extract tax loss harvesting to offset those gains. It's a very, very strong play. And I have some of that too, where I have some of those very low yielders that have popped. That, what are you really waiting for with them? You know,
What are you waiting for? I
yeah,
know what you did last summer.
that's right. So I guess the question is for all of us out there, to all of you, we'd be curious what your thoughts are. Did you start in the individual stock world like us and migrate with some ETFs? Has your mentality changed altogether over the last few years? We'd love to hear your thoughts on this.
Guys, we're all in this together. We're all about getting better together. You might be at a different stage in that personal finance journey. Right now, where we're at, given with our experience of going through this, hopefully the wisdom is pouring out to you. Is it just may be easier to do more in ETFs and less in individual stocks, not stopping the individual stocks, but just really focusing on the stocks that will perform forever. That's what it's all about here, guys. So let us know in the comments. Smash that subscribe button. Give this video a thumbs up if you haven't already.
You know what? We also need to tell the people one more thing. If you're not with us, you're against us, Jack.
That was Bert, the Hurt Man, and Lanny from the DD. Over and out.